We are live.
We are live back again, huh?
Hello, everyone. Happy Wednesday. Happy Wednesday, Chris.
Hey, how you doing, Abby?
I'm doing good. I'm doing good. How was your week?
Come on. It's been an eventful and busy week. So just getting it together. Yeah, improving every day, following up, getting it going, right?
Yeah, same here. Same
Same for
here.
you, huh? In the
Mhm.
real world, right?
In the
Well,
real
let's
world.
go ahead and get it started. So, guys, I'm Christopher Bush, financial advisor,
I'm Abby Joseph, your tax strategist.
guys, and I just want to welcome you to another episode of the Red Line, right? So, let's go ahead and cue our intro, Vic.
That's Hunter. That's Hunter.
And we're back. Welcome, guys, to our part two of insurance as a whole. I hope you guys enjoyed last week session, and we are going to continue this session. Hopefully, too, by the end of the session, by the end of the month, we'll have some amazing guests for you guys, right? Right, Chris? We'll have some guest speakers for you guys that
Yes,
also want
ma'am.
to kind of like finish the session for us for life insurance, for insurance as a whole, not just life insurance. So, what
Yeah,
do
and
you have for everybody tonight?
man, I got a lot. Because again, it always comes to me. So I was just thinking. I mean, man, this is we insurance is like such a heavy topic, and man, it's just a lot. You know, so many moving parts. So today, what I wanted to kind of focus on is last week. For me, we talked about a lot of the different types of
Hmm.
insurance,
Yes.
and we primarily focused on the life insurance side.
Correct.
And we talked about the different types, and then maybe like how to assess how much you need. And today, I
Hmm.
kind of wanted to break it down a little bit to help you understand how that actually fits into somebody's budget, right?
Okay.
Because I think that that's going to determine what type of policy somebody can have as well. One second.
No problem. So then, guys, remember last week we talked about the different type of life insurance. This week we're also going to tap a little bit into business, right? Business insurance. So one of the questions that we get a lot is, Abby, how is business insurance or tax, right? When it comes to business insurance policies, your premium paid, your the premium that is paid with your business insurance premium, they are typically a tax deduction. So, as a business owner, if you have E&O, which is error of emission insurance, that is a deduction. If you have life insurance of your partner, the premium is a deduction. So you have so the premium are typically tax deductible as a business expense, as long as the coverage is directly related to the business. So if it is a life insurance, you want to make sure the beneficiary is the business. If it is E&O, right, error of emission insurance, you want to make sure again that is for the business, that it is under the entity. So yes, that can actually be a deduction. So you want to make sure that that is directly related to the business. However, certain type of insurance policies, such as life insurance policy, may not be fully deducted. You want to make sure that life insurance policy is actually a partnership or business insurance policy. Also,
Abby, just I know we kind of touched on this last week, but I just want for our new people for this
mhm.
episode, can you just go back real quick about the difference between a life insurance or an insurance deduction versus then an expense? I think that's a kind of huge. Always make sure that we cover it because some people think, well, just because something is an expense, that means it's also a deduction. And can you kind of clarify the difference on that?
No problem. Remember, whenever you have a business expense, even if it's that is a deduction, you want to make sure that that expense is reasonably reasonable and necessary. So the expense itself has to be related to the business purposely. So then let's just use the business life insurance policy, right? The business life insurance policy, the reason why that premium is a deduction is because if me and Chris goes to business together, my goal is to make sure that my business is protected. Because Chris is an asset to this business, right? God forbid, Chris goes to heaven. Now, whatever part of that business that Chris was handling is impacting the business as a whole, then it's important for me to have that policy. It's important for me to have that insurance. So that would be considered a necessary. That would be considered a necessary expense. So that would be a deduction. So the premium for that policy is a deduction. So we always want to make sure that regardless if it is a life insurance, or regardless if it is a E&O insurance, right, error of emission policy, we want to make sure that those expenses are necessary and reasonable. Hopefully that answers that, Chris.
Yeah, absolutely. Thank you for that, Abby. I'm pulling one illustration and I kind of want to talk about on the expense side. Now that you're talking about expenses, let me pull it up for us. Where's my PowerPoint? Okay, here we go.
While you pulling that up, one of the things too is you want to also look into how the payout of the policy, right? One of the questions that you'll find people ask is, Abby, is the payout of the policy is that tax? When it comes to the payout of the policy, if the business receive an insurance payout due to a loss such as damage to property or a liability claim, the payout is generally considered taxable income. So I own an accounting firm. You walked into my building. Sorry. I own an accounting firm. You walked into my building. Right, you walked into my building and you hurt, I hurt myself or whatever, and now I'm getting an insurance payout. That is considered a taxable income. However, though, the amount of the payout that is taxable will depend on the specific circumstance and whether the payout is for a capital asset or revenue. So this is where too, when you do receive that payout, you want to sit with your accountant. You want to also, even in advance, if you're going to have that claim, you want to talk to your accountants. You want to let your accountants know, hey, listen, I am about to receive a lump sum of cash based on a payout of a policy. So then now your accountant or your tax strategist, they'll be able to let you know how are you going to be taxed on that. All right. So you want to make sure, one, you communicate and you are transparent. A lot of time, the reason why an accountant, it's so hard for an accountant to be able to help is because there's a lack of communication and there's a lack of transparency. So you want to be able to be transparent with your accountant and let them know. Another thing too, guys, is captive insurance company. So some business may choose to create a captive insurance company, which is an insurance company that is owned by the business and provides coverage to the business. So captive insurance companies can have tax advantages, such as you're able to deduct the premium that is paid to the captive business expense. And potentially you can actually reduce the overall tax burden of the business.
Yeah, so it's kind of like having, again, owning your own insurance company yourself, right?
Correct.
So that's again, guys. So that's one of the high net worth strategies that that we're also going to get into further down the line. But that part is huge for business owners that have a huge gross revenue and they need extra tax deductions, like having a captive insurance policy, insurance that they're creating, again, their own insurance, not just a policy, but almost like a company, right? For their business.
That is correct. So you want to make sure too, you do speak with your accountant when regarding those things, so you'll know how your taxes are going to look like prior. Tax planning is so big, and I know that's something that we'll probably start speaking about in the month of July. But tax planning is tax planning is more important than actually end of year tax return. Your in-year tax is half of the work. Tax planning is everything. Okay, so that's one area. The other area as well, too, guys,
Did we
is
lose Abby?
health insurance businesses. It's health insurance businesses. So your health insurance businesses maybe provide health insurance coverage to your employees. Let's just say I have 4 or 5 employees in my firm, and I want to offer health insurance, or I need health insurance for myself. So health insurance businesses may provide health insurance coverage for your employees, or for yourself. So you either can use like a group health insurance policy through a self-insurance plan, but the premium that is paid can be paid by the business, and it can also be a deduction. So it is tax deductible as a business expense. And the employees may also be able to exclude the value of the health insurance from their taxable income. So it's very important for you to know, like, let's just say, I don't work a 9 to 5, right? But I need health insurance. So if I don't work a 9 to 5 and I need health insurance, I need to be able to pay for health insurance. And that does not need to come out of your pocket. The premium for those policy can also be a deduction. Okay, so if you're an LLC, a contractor, if you are an S corp, if you own your own business and you need health insurance, that also is a taxable deduction. Okay, and I think the last one that I have for you guys.
Go ahead.
Okay,
No, go ahead. I'm trying to get my camera to work. For some reason,
I'm
going black. Sorry.
You're good. The last one that I have for you guys is employer provided life insurance, right? If a business provides life insurance coverage to its employee, the premium paid by the business is a deduction. So if I offer life insurance to any of my employees at my firm, that premium is a deduction. So the premium paid by the business may be tax deductible as a business expense. Whenever you read IRS publication, you will see that IRS always use the term maybe. And the reason why IRS use the word maybe is because every circumstance is different, right? Even I remember when I was taking my exam, no, it wasn't my exam. I messed up on a return one time, and but I did it based on what the publication said. Like, I literally did everything exactly how the publication required for me to do it. And IRS literally came back to me and said, hey, listen, you can't depend on the publication. You have to do a lot more research than just the publication. One, the publications, a lot of them have not been renewed, so they are extremely old. So you want to make sure that you do speak with your accountant. And the reason why is because, two, your accountant has to do what's called continuing education every year. So whatever the changes, they're getting the up-to-date changes. It may not have changed yet on that publication. So you will find that IRS will say a lot, may be tax deductible, may be an expense. And the reason why is just because, right, you had an expense, it doesn't necessarily mean that expense is a deduction. So you want to make sure that you do communicate with your accountant and make sure that you are able to actually deduct those expenses. All right, guys. So we went over premium paid for business insurance, right? We went over insurance payout. We went over captive insurance companies. We went over health insurance, how health insurance for you or for your employee are tax are deducted, and we also went over employer provided life insurance. Okay, guys. Hopefully, if you guys have any questions, you guys definitely can drop it on the link, and I'll definitely can answer them for you on a taxable level, how it is taxed. All right, guys. How we doing over there, Chris?
Well, I don't know what's going on with my technology today, right?
There you go.
It keeps on popping in and out, so I'm gonna try to do my best to kind of keep on track. So I apologize, guys. We do it live.
I got you covered.
You did an amazing job, right? So one thing that I want to kind of go through today is when we're looking at the subject of insurance and how much to pay for, because screen real quick. And we're going to go share screen and we're going to go to Windows. We're going to go to here. All right. So check us out. So we talked about last week, Abby, when it comes on the life insurance side, that's the part that I'll kind of stick on for a little bit. Because I think that, again, that's one of the most financially purchased product, the number one most understood. So we understand it in different types. Okay. So, and there's a lot of talk, you know, again, when you're looking about, okay, what type of insurance do I get? A lot of times people are kind of confused about, hey, should I get term? Should I get a whole life? Should I get universal life? And no matter who you talk to, a lot of times there's going to be a different opinion on what you should get. Okay. And for me, it really boils back down to, unless somebody is talking about their personal financial plan, it's kind of hard to help people understand what they should have. Right. Yeah. I know for me, I know what 80, 90% of people should probably have based on their budget. And I think that's what we got to get used to. Okay. So let me kind of break this is what I kind of saw. I was kind of, trying to get to understand what does an overall budget look like, because it affects what type of things that we do. Okay. So I don't know how many people really do this, Abby, right? When we're looking at our finances, truly, let's be real. How many people really kind of have a go by as far as percentage of their household, or break it down of how much money should be spent in these 9 categories? Do you think people actually do this?
No.
Most people, right? Most people do it, right? Yeah. Do you think that most people, or let's even think about, so most people from an advisor standpoint, they don't for if you're an insurance agent, most insurance agents don't go this detailed as far as looking at somebody's total plan to figure out, okay, how much insurance should they have and how much should they be spending on a particular policy? Does that make sense?
Yeah, that makes perfect sense.
Right. If they're not doing that, sometimes they're going to be doing the client a disservice, because you can say, hey, look, you should be spending $300 or $500 a month on this policy. Okay, but at the same time, how does that compare to what they're saving? How much does that compare to how much they already have into their emergency fund? How much they have into a short-term account? How much they're contributing to their 401k, right? If their company matches them up to 5%, are they maxing out the 5%? Are they maxing out their Roth IRA? See, there's so many different pieces that fall in place. So if I have somebody that's too insurance heavy, yes, it's great. People say, hey, Chris, I want to have $3 million worth of life insurance. Great. Yes, I think we probably should. But at the same time, if it doesn't fit your budget, then it may not be time for that much coverage just yet, right? So one thing that I look at here, right? One thing that I look at here is, like, from an insurance standpoint, it says, hey, look, from health, medical, auto, life, it should be about 10 to 20% of your budget. Okay, so that means that if somebody's making $50,000 a year gross, right? I mean, if you're looking at 20% of your budget should go towards some type of insurance stuff, then you're looking at about $10,000.
Correct.
Right? A year. So normally when you look at auto insurance, for a lot of people, if they have a family, there's probably going to spend $200 a month or so on auto insurance. What's the average? Somebody Google that from me in the chat. Somebody Google, help us out in the chat. I should have did this. What's the average premium for auto insurance of a family of 2? Right? Y'all can do that. Or, right? So it's probably around like almost 200, between like what, $130 to $200 a month. Abby, are you Googling it?
About $1,134 for the year.
Right, about $1,134 a year. So that's about almost like $90 a month or so.
Yeah.
And that's for a family or individual?
Individual. Let's see. What about family?
Yeah.
What about a teenager in your policy? Ooh,
come on. I mean, that changes the game, right?
Ooh, so Lord, I'm not ready for that.
Right. So think about it, guys. So if we understand, so when I break this down into insurance, the rule of thumb is this: about 6% of your gross income can go towards life insurance. Right. Or I actually made a mistake. Y'all, Lord have mercy, I made a mistake. On this, don't look, it's not 5 to 10 times. Okay, yeah, that is right. So, and you also want the amount of coverage should be 5 to 10 times the amount of gross income that you have, or it's about 6% of your gross income. That's what I meant by that. Okay. So think about that. If somebody is making $50,000 a year, right? And this is life insurance coverage outside the job. Guys, if you have life insurance coverage at your job, that coverage doesn't count. Okay.
It does not.
When I'm speaking with somebody, oh, Crystal, I got insurance at the job. Okay. If you leave the job, what happens to that life insurance coverage? It
all depends on because
it depends a lot. Sometimes it can be portable, right? Meaning that they can carry it on with them. But most of the time, I would say 80% of the time, if you leave the job, that life insurance coverage goes away, right?
Yeah.
Right. And if it is portable, normally the insurance coverage that you're paying, the amount of money that you're paying per month is also going to increase. Right. So it's just not, hey, look, unless you get like, a lot of people have like, hey, I got insurance at the job, but it's really your own physical policy because you got Colonial or you got Aflac, or it's just being deducted through payroll, but it's actually your own physical policy. Right. But what I'm talking about is actually life insurance that your company gives you, typically 2, 3, 4, 5, 10 times your salary that you have at the job, but it's normally free or a little bit of money. That does not count when it comes to life insurance, right? You always want to have a physical policy that you own, right? That you can control, that you're working directly with the life insurance company. Always have life insurance coverage outside of work, right? It doesn't count at work, right?
Definitely.
Right. So when we're looking at this, guys, and we're trying to figure out, okay, well, what type of policy do we have, right? Well, if you're so it doesn't make sense to get an extra insurance at the job. I mean, I'm not saying that the insurance at the job is good. I'm saying that it doesn't count when it comes to counting towards you having insurance, because again, if you leave the job, the insurance goes away. For instance, I had a young lady actually did her mom's insurance for a long time, and her mom was like, "Hey, daughter, you need to go ahead and get life insurance." She said, "Well, I don't want life insurance. I don't really believe in life insurance. I have it at my job." She was 27 at the time, Abby. Okay. Fast forward 6 years, she was 33. What happened? She called me back. She said, "Well, Chris, I actually got diagnosed with breast cancer, and now I'm not working at that job, and now I don't have life insurance coverage for my kids." She has 3 kids. So now she doesn't have insurance at a job because she's not working. Now she got diagnosed with breast cancer. So typically when you have cancer, it gets super tough, right, for you to even get life insurance coverage. But she was like, "Well, I already have it at my job." See, that's why you want to be insured early on, right? While you're young, while it's cheap, while you're healthy, right? And so we do, "Hey, Chris, I want to get insurance for my father." My father's 73 years old. Okay, man, it's going to cost a lot of money for that to come out. You know what I'm saying? Right? It's going to be quite a bit of money. My daggum, whatchamacallit, internet webcam is coming out. Let me see if it works again. Okay, well, all right. So it's so important for you to get it while you're young, while you're healthy, right? So as long as long-term insurance is also that for long-term care. Yeah, and that's an interesting comment that you say, Charles. We're going to cover that. That's an interesting product to have, right? I think it's a powerful product and people should have, but more and more, there's a lot of most long-term care insurance companies are not in business anymore, or most insurance companies don't actually provide a true long-term care option. Okay. Now, it's number one, because it's super expensive, right? It's really hard to underwrite nowadays. And I think it's something that everybody should have, but it's really a difficult topic to take, because sometimes to get just $100,000 of long-term care, somebody may be spending $300 to $400 a month just on that, right? To have a bucket of that amount of coverage. So that is an important insurance to have. But again, it's so based upon this overall budget, and right, it's powerful to have it, but it's definitely expensive to go through. So going back to this, Abby, what I wanted to cover is that understanding that if you're, let me pull up my Excel sheet. Let me see if I can pull this up, and maybe this will make a little bit more sense. Stop share again, share screen, window. Y'all getting this all live. It's not recorded. Like, we got all this stuff, It's like, why don't y'all have this together? Look, we on the floor, like we're doing it together, right? So check me out, Abby. Okay. So let's say if I'm saying, hey, look, 6% of your gross income should go towards life insurance. Somebody's making $50,000 a year, right? That means that they technically should be able to spend around $3,000 a year for life insurance. That's $250 per month. Okay. So
Okay.
think about this. If somebody gets a whole life insurance policy and they're saying, hey, look, I want to put $250 per month away for life insurance, you're only gonna get around. Hold on, I got that pulled up too. Hold on, let me go to my little cheat sheet. You're gonna get around, yeah. If you're spending, again, this is a I don't know what's going on today, guys. Hold on. Y'all can see my screen though, right?
Uh-huh. And we can hear you.
I do not know what's going on. Okay,
There you go.
I'm back. So if we're making, let's say a whole life or IUL policy, those would be cash value policies. Okay. Now I'm just going to talk numbers today. I'm not going to go too much in detail with the theory on things because I'm not trying to be biased. I'm a numbers guy, so I want to look at the numbers first. But we can kind of talk about scenarios. But let's look at true numbers. Okay. And when it comes to death benefit, we're going to look at it from a death benefit standpoint right now. And we'll go into looking at it from a savings standpoint or a secondary investments or a tier one and savings vehicle, all that good stuff. But think about it. If you're having a whole life or IUL policy, you're going to get what, $250,000 worth of life insurance coverage, right? A roundabout, right? So with that though, Abby, having 250 grand of insurance, but if somebody passes away, I mean, what is 250 really going to do for a client?
Well, it can do it could do a lot.
It could do I mean, so it depends, right? So think about it. So if somebody had, let's think about it. If somebody, the average income, think about this, guys. What's the average income of American household in the US?
I would say between what, 60?
Just like
60
50
to 80.
Again, somebody Google it for me, right? It's again, the average income of an average household is like 50K, right? I think 57,000. Right. So, but again, if somebody passes away and they lose the income, let's say that's one spouse is 50K.
Depending on the state, but around 60, 59, 60.
So that means, Abby, if they don't have any debt, if they don't try to pay off the home, if they don't have a home, if they don't, so if they're just looking at it from an income replacement standpoint, 250K is only lasting how many years? It's only lasting 5 years.
Yeah, or less.
Again, that's going to be less. So again, when you only have 250 of insurance coverage, let's say that family has a mortgage. Typically in most families, when you use the family, that's a loss of income.
Yeah.
Right. So if it's a loss of income, technically it probably took two people to cover the mortgage.
Correct.
So if it took two people to cover the mortgage, right, and then somebody passes away, now more than likely what life insurance is supposed to do is you're supposed to have enough life insurance coverage to pay off at least half the debt of the mortgage, right? So that means that the client can actually refi the home, bring the monthly payment down because now they got rid of that debt and they can stay in the home. But what happens most of the time, because some people don't have enough life insurance coverage, right? They end up losing the home.
Yep.
So that's why, again, when you're looking at the types of life insurance policy, yeah, I can give somebody a whole life policy for $250 a month. For $250 a month, get $250K, but do they really have enough coverage? Or temporarily, would I say, okay, well, if we got $250 to work with, right, for insurance, then I probably can get them a term policy, right? I probably can get them a decent, like if they're 40, this is on 40 years old, right? A 40-year-old male can probably get $1 million life insurance policy for probably about, again, depending upon the medical and all that good stuff, anywhere between $60 to $80 a month for $1 million. Right. Well, I'll even say, let me go back because that's probably preferred plus. Let me say between $125 a month, somebody can get $1 million of coverage.
Okay, so quick question. Can't we do a term and a whole life combined? Like, let's just say, can I do let's just say I want $1 million policy. So can I do like a $500,000 term, right? Okay. And then a $500,000 whole life. And for the term, once the term hits, can it convert to the whole life?
Yeah, so we can do stuff like that, right? So let's look at it, right? So yeah, you can combine it, but also I want to help people understand how they're combining it as well, because again, if they're not saving enough, Abby, than me having, because think about it. Let's say if somebody they say, hey, Chris, I got 250. I want to use 125 for term. I want to use 125 for whole life. Okay, that means on the whole life side, I'm at for $125 a month. I'm gonna get $125,000 worth of coverage, right? Give or take on the cash value whole life policy. So let's look at it. Let's look at a compound interest calculator. Okay, because with a whole life policy, you're gonna pay that 125 your whole what?
Your whole life.
Pretty much your whole life. Am I right?
Mm-hmm.
So if we start off from zero, we'll say somebody's whole life from age 40 to age, let's say 75. So that's for 35 years, right? And we'll say, I'll do it easy. I'll say an 8% return, right? And we'll say $125 a month.
Okay.
Check this out, guys. I keep on going. Dang it, I go blacked out again. Did I? Yeah, 1 second.
Mm-hmm.
All right. And this is why it's so important to have a plan, right? Yes. Everybody like combo, right? Let's look at it. Let's take that scenario. Watch this, Abby. Again, this is I'm just going on the numbers.
Mm-hmm.
Right? Going on the numbers. Let's look at it. Now, let's look at this. So if we say 120, if we got 250, we got 120, we got 125 on hold on 1 second. We got 125 on the term side and 125 on whole life. You're going to get a death benefit around a starting amount of 125,000. But if you're just saying at an 8% rate of return, you're saving that 125. After 35 years, you got $267,000.
Mm-hmm.
So after 35 years, if you have a whole life, what benefit did a whole life do when you just could have saved an extra 125 and had $267,000 saved up?
And realistically, how old did you say they were again? 40?
I'm just saying 40 years old. I said 40 to 70.
Okay, so let's say we're 40, right? Plus 35. So at 75 years, at 75 years old, all I'm thinking to myself is, by that 267,000 is probably $5,000 value. Right. With the way things are going, Chris.
Yeah. So that's why, again,
35 years from now, $200,000 is probably going to be $5,000 worth of value.
Yeah, so it's still not a lot. Do you see what I'm saying?
At all.
That's what I'm saying. Sometimes people say, okay, do a combo policy, but what is the true value of the combo? If you're paying this your whole life, 35 years is $125 in this example. We're using a $50,000 example. Okay, but you could have invested the money, have around 267. Now, so now this is what I would do. See, now at 75 years old, I still want to have a death benefit, but I don't want to pay a premium forever. So what I would do is I would take this 267, actually make it into a guaranteed product with a guaranteed death benefit with the floor, only upside potential. Then that way we just made a insurance policy for ourselves with no fees, no monthly payment, and that policy death benefit can continue to grow. So see, I would make it as an investment plan that's guaranteed with the floor, with a guaranteed payout and guaranteed growth versus me paying a life insurance company forever in a split plan. Does that make sense?
That makes sense.
Right. So see, it's about using all the financial tools and the financial products. That's why I'm highly suggesting, guys, if you're getting life insurance, you want to talk with somebody that's not just a life insurance agent, right? Make sure that person has an investment license. Make sure they have an insurance license. Make sure they know how to do a financial plan, because now we can plan this stuff out. Because I can make a whole life of IUL sound good. Right. But at the end of the day, what do the numbers tell me? Right. And again, what do the numbers say on that part? OK. Does that make sense, Abby?
Mm-hmm.
Right. So what can happen? Let me stop the share. What can happen? This is at 50K. Yeah. So as we start to grow, right, from $50,000 of income, right, as we start to grow, and maybe we're making $100,000 a year. See, now we got $500 to go towards our insurance plan, right? So now we can make a little bit difference. Now we can, some people would say, hey, now we can squeeze in a type of whole life, because now I can spend $200 a month and have $1 million, $2 million worth of life insurance coverage. So if something happens prematurely, right, over the next 35 years or so, right, by the time I'm 70, 80, now I know that that's going to pay out $2 million, right? But now it gives me 30 to 40 years to make sure that I'm investing correctly, right? To make sure I build it up, Makes sense? It goes hand in hand. Right. So, if I'm started making 300 grand, now I got $18,000 to work towards an insurance plan. Okay. And then we can kind of get into a place to where, okay, some people are infatuated with the cash flow banking and infinite banking and Bank of You and those type things. But if you're not able to fill the buckets of everything else, right? If you're not able to have a fully funded emergency fund, if you're not able to have a good short-term account, funding your Roth IRA, funding a 401k, you have in real estate, you have income, like that's not a product that I would suggest for somebody that's starting out, that's trying to get things going. Does that make sense? There's other pieces that should be in place before then, right?
What order though? Sorry to interrupt you, Chris. What order would you say? So I know in the beginning of our show, we talked about budget and we talked about different type of accounts that you guys need to have. My question would be then, what order would you think would be in our audience best interest to start? Okay, do we start with the emergency fund first? Or do we need to start with the life insurance policy first? Or do we need to wait till we have reached that emergency fund amount? Then let's move to the next. Or should we be cutting our income to where, okay, a little piece goes to life insurance, a little piece goes to the emergency fund, a little piece goes to the money market? How would in what order of importance would you say we need to have them?
Yeah, I think it's important. Number one, when it comes to insurance, again, like when you go get a car, you got to get life insurance the same day, right? Legally, right? When you go get a cell phone, you're probably going to get cell phone insurance at the same time, right? When you go get a home, the first thing before you even close in that home, you got to get mortgage insurance, right? So it's so unbelievable to where we'll get between our car, our mortgage, our phone, our health insurance, we'll get all those things the same day that things happen, but we always wait for insurance.
That's true.
You know what I'm saying? So life insurance, you should get it like yesterday.
When you're born.
Yeah, when you were born. Is a non-negotiable bill in the household. Like I said last week, my dad said, look, you can cancel every bill in the house, but just don't cancel the life insurance. So for me, having a life insurance policy, just even if it's something, it may not be everything that you want in the beginning. You may not be able to afford $1 million, $2 million policy. However, you need to have something in place, right? That fits inside your budget. Okay. And then you can always grow into having more coverage over time. Okay. And so number one, that's important.
Yeah.
The second thing is having an emergency fund. Right. I think that because people say, Chris, fix my credit. Hey, fix my debt. Like, again, it's not about you fixing your credit, is because the reason why you have bad credit is because you don't have an emergency fund. If you had an emergency fund, you wouldn't have used the credit card. You wouldn't have you wouldn't have gotten into debt because you would have had an emergency fund set. So the first step of building credit is not just trying to finagle the system or trying to send all these letters. You got to change your money habits. And so let's say when I get a big tax return, don't just go pay off all your debt when you get a tax return. Right? Okay. Think about this, guys. If you have like $5,000 that you got from taxes, most people, they do what every year? They go back and pay off their debt every year with that same $5,000.
And then they use the same credit card all over again.
Exactly. Well, why do you?
I never understood that.
Right? Right?
I never get that.
Right. So what happens is you got to pay yourself first. So have an emergency fund, pay off debt, right? But so you got to make sure that you establish some type of emergency fund to where now throughout the year you're not go swiping that credit card. So I think having insurance is like you got to do that, right? I would say next step is having an emergency fund. The second step would be probably like paying off debt. Like, and even if you follow Dave Ramsey, I don't mind like the first 3 or 4 baby steps of Dave Ramsey. Now, after that, it kind of gets I would probably have a little fight with him, right? About what to do next. But again, those baby steps that he teaches is so fundamental, and it's you can't look over that.
Yeah.
Right.
I agree.
So I think if that maybe can help some people of understanding, because it's not just don't look at life insurance as an investment. Don't look at life insurance like it's supposed to do all these 1,000 things for you, right? Like, let's keep it basic. Like, you got to save and invest outside of your policy, because again, life insurance is typically a tier 1 asset. It doesn't necessarily grow very quickly. right? Especially in a cash value policy, you may not be able to can touch the money or Chris, I want a policy I can borrow from. Okay, first you need to have money that you can access in case something happens, not just borrow. Like, why are we thinking about borrowing first versus money that we can access?
And I tell people that too. It's not that, again, it's not that Chris and I are saying that life insurance cannot become an investment for you, but there are timing for it, right? So it can become that once you get to the level or the place where, you know what, you're speaking to your accountant, we're looking at high tax liability, we need to move money, then let's talk about an IUL, right? So I think there's places for things in the financial world.
Yeah.
There's timing for things in the financial world. So if I am 18 years old and I am in college right now, yes, having a life insurance policy is important, and also start working on my investment. Right. Yeah. If I'm in my 40s, my biggest deal is, it's going to be more investment, a little bit more harder than anything. So and it all depends on how our incomes look like,
What's that breakdown? And I think that's I think that's so important to where it's the work that nobody likes to do, is that percentages in the breakdown of their budget, of understanding what you're spending. And unfortunately, guys, a lot of these things sound so sexy, but at the end of the day, you got to do what your numbers say. You got to do what the numbers say in your account, right? And understand, don't be in such a rush to say, hey, look, I want to have all these 1,000 different strategies to work for me because I'm trying to get ahead financially. Sometimes the starting off with the basics is the best thing, right? Starting off small, starting off, understanding how everything is going to fit, and making sure that you're just not spending everything on insurance, but we want to make sure that we're investing as well, and we're saving money in different places. So
I agree 100%. Another thing too, I highly recommend, like, the day Serenity was born, the day Serenity was born next week, we got a policy for her. So if you have your children's, start out a policy with them early. Like, you can literally get a simple IUL for that child. Listen, that will help them. So don't wait till you get, just like Chris was saying, don't wait till after you get sick for you to have the realization that you do need life insurance. So your children's, make sure you do have some life insurance for them, and not just life insurance, but you also want to have health insurance as well for them, for you guys. I hope you guys enjoyed the show. Now, don't forget the whole series.
Go ahead. No. I'm going to see if I can find. No, I was going to see if I can find one more thing to show, but go ahead. Go ahead. Go ahead.
Okay, while you look for it, don't forget the whole series, guys. We're going to talk about insurance as a whole. So my homework for you guys is that let's start making this a norm, right? So when you watch the show, I want you to start talking about insurance in your dinner table. I want you to start talking about insurance with your children. So I remember when I sat Serenity down and I was like, hey, listen, here are the documents. Here's this, here's that. And she's like, well, what, Mom, why do we need all? It's important to actually have those type of conversation as a family, as husbands and wife, as significant other, and even with your siblings and with your parents. So start making these conversations a norm all around. So we do not have to do GoFundMe.
Yeah, and I think this is actually, one kind of example I kind of want to show to another way to use insurance. Again, we talk about generational wealth a lot, and I think this is a way that you can start formulating it, right? And this is where, as your income grows, right, you can start to build more generational wealth and really build out a plan with insurance, right? So let's take it, for instance, let's say my mom and my dad. Let's say I have $250,000 of coverage of insurance that my mom and dad own, right? So they own the policy, they pay for it, they have their own insurance. Well, since I'm their son, right, legally I can own insurance on my mom and dad. Right. So let's say that now again, that's why it's so important to go through this. So now as a son, I can say, hey, look, I can own $250K on my insurance of my mom. I can own $250K of my dad that I pay for. right?
Mhm.
And again, I'm not doing this to make money off my parents. We're doing this because we want to live a legacy. We're doing this because we want to build an asset, right? We
Mhm.
want to build. This is how you really build a family bank, right? This is how you really start to build generational wealth when you understand the power of this part here. Okay. So
Mhm.
now my daggum camera went out. Hold on, guys. I don't know what's happening. Maybe. Let's see. Okay, let me do it this way. Sorry, this was some good stuff. We're gonna kill it. Let me try one more time. Man, I think I probably just need to get a whole new computer, huh? Yeah. Okay, it's not gonna work. So y'all can just go. I'm not gonna be.
We can see.
Right.
We can see and hear you.
So we can do it this way.
Mhm.
All right, we can see. We'll see Abby. Right. Well, can we make it to see Abby? Right. So
No,
anyway,
you can
so now
continue.
think about it. So now, God forbid my parents pass away, right? What's going to happen with an insurance? That'll be about $1 million worth of life insurance coverage. Okay. Now, since that $1 million of insurance coverage is going to go to a family trust.
Yeah.
Right. We're gonna set that up as a trust. So that's $1 million. So think about this as it pertains to wealth. And this is why we talk about, hey, we need to shrink the wealth gap. But at the end of the day, I don't think we can really shrink the wealth gap. We can just participate because money has been doubling for way too long, right? We can't just catch up automatically. Money has been doubling for way too long because think about it. So if you have $1 million life insurance policy that went into the trust for 30 years, just at a 9% rate of return 30 years from now, right? When my daughter turns 30, right, in her 30s or so, boom, the family trust will be worth about 14.7 million.
Yeah.
Right. So then now we transfer that to the second generation. So now the second generation, now that 14 million, right, invested, now that goes about 216 million.
Mhm.
Right. When my kids have kids, right? And then when my kids have kids, boom, that's $3.1 billion all because of what? All because of one life insurance policy. Right.
Yeah.
So that's the part that makes sense. And I'm not even thinking about the strategy to where, okay, well, I just said that I can own insurance on my parents, but now from the trust can now own another insurance policy on me. So now the trust can actually pay for a $5 million or a $10 million policy, a $20 million policy that the interest is being paid for from the trust account. And now that when I pass away, it also replenishes the whole account as well. So see, guys, that's how you're able to build
generational wealth.
Build generational wealth and really have money. Somebody said a GoFundMe for Chris camera. My camera's tight. It's just my connection is bad on my computer. I ordered a new Mac. But anyway, so that's why it's so important to make sure that we do that and we have a strategy. But guys, you can make sure that that's right. I just wanted to kind of show that for you.
Yep. And realistically, that's an amazing start point in building that generational wealth.
Right.
So we have to start having that mindset of not just present, but having a mindset of those after us. I think the biggest issue we as a culture have, we only think of now. We only think of present. We don't think of the future of generation. So I think even as we have in these conversations, there's so many people until now that we are still doing GoFundMe for funerals. That is what we need to stop at. We need to stop at that. So I would definitely say, let's be the first to create that, that generational wealth, that door, to open that door of opportunity for the generations that are to come, and not just for present.
Absolutely.
Yeah, definitely.
Well, good stuff. Well, boom. I guess so. That was the last thing that I wanted to cover. I know we're almost cut on our time, and of course my camera went out. Other boom, never look at me.
No, you're good. And I absolutely agree with Marquise. The kids can learn to be better with money. So what you want to start doing with these children, and even with my daughter, just her being the only child, she's spoiled. So it's important to start teaching them how to have a relationship with money, because if you teach them how to have a relationship with money, that money that you've left, they'll know as well too how to continue. And you know what? You can also put some rules. Like I know with me, I put some rules, and my rules are strict. So you can literally say, hey, listen, this $3 million that I'm leaving you, all right, you can only have one. The rest of the two is for your children's. So you can actually create guidelines for you can create structure. There's so much that you guys can do when it comes to generational wealth. We just have to get out of the mindset of just present, and then educate these kids from the day they are born, as little as you can. Educate them on how to have a relationship with money. Yeah.
I love it.
Yep.
I love it.
Let's see. Do you guys have, okay, Brandon, yes, you can definitely email us at help@thecomeupseries.co. Don't forget, guys, the best way for us to actually bring you guys these education is by sending us your situation, by sending us your questions. So make sure that you do email all of your questions to us. And remember, this month's series is about insurance, so you will hear all about insurance from us. I hope you enjoyed tonight's show. Any last words, Chris?
Man, I think we said a lot today that that should help some people, and yeah, I'm just excited to kind of get back to it next week. And again, like you said, put Vic, if you can put our email address up again, just to make sure everybody has it. Maybe I need to tell Mark to like get us a website and stuff that they can just click a link,
Yeah, yeah, definitely. Another question too, someone did send to us. They wanted to know, okay, if you guys actually want to work, if you are looking into either Chris or our service, I actually do have a community that I serve. It's called Trader Tax 101. You can go at the Relationship Accountant. If you want to be part of our community, and in our community, we teach taxation, we teach you how to trade under entity, insurance, budget, real estate taxation, trading taxation, business taxation, tax planning, in our community, in our Discord. Or you can also visit us in our website, or just send us a picture, and we'll be happy to actually assist you both.
Perfect.
We both will be happy to assist you guys.
Yeah. Just send me a message on IG or send me an email. I got some new things coming out in June that I'm pretty excited about, so I think everybody's going to be pleased. So look out on June 2nd. Yeah, June 2nd. Look out. Some new stuff from me that's going to come out. So you guys will get a lot of great information, a really great community to be a part of, and we're going to make it happen.
All right, awesome. Well, thank you guys so much for showing up. We'll see you guys next Wednesday. I'm Abby, the relationship accountant and your tax strategist.
And I'm Chris, and my camera never works.
And thank you for joining us with the red line. You guys have a great night. See you guys next time. Bye.
Bye-bye.